Welcome everyone to the latest edition of the JMI Wealth video update for 2025, and what a month it has been. We're recording this in early April, and so far April has been writing itself into the history books. Now I'll try and recap the key events and then also try and make some sense out of it all in terms of what it means for investors over the rest of the year. Now, when we filmed the last update, we'd sort of talked about the change in momentum within share markets and the headwind that was the relatively weaker performance of the Magnificent Seven. Now that issue is now almost a bit part in a much larger drama because there have been monumental developments since then. For the record, March was almost universally a weaker month for share markets. The NZX 50 lost 2.4%, the Australian market fell 3.4%, and in the US, the S&P 500 fell 5.6%. Now interest rates were mostly lower over the month. As we closed out March, though, there was great anticipation around the impending announcement of President Trump's tariff policy. This was duly delivered in the White House Rose Garden on the 2nd of April. Now, what was announced was notable for two main features. The actual levels of announced tariffs were much more onerous than had been anticipated. And secondly, the basis for arriving at announced levels, it was unexpected, it was initially quite opaque, and has subsequently been widely criticised. So look, let's just dig into those 2 points a little more. The tariffs that had been announced, which came into effect on Thursday, the 9th of April, lifted the effective tariff rate on all goods imports into the US to 24%. That is the highest rate we have seen in over 100 years. That was a seismic shift in global trade policy and settings. Now, the rationale from the US president is that where the US has a trade deficit with another country, they import more from that country than they export to it. He believes the US is losing, despite the fact that there is a clear exchange of value. I mean, they get something when they buy those import goods. They get a car, they get a t-shirt, and despite the fact that there could be a significant difference in wealth, i.e. the other country could be quite a lot poorer. The overall level of import tariffs that were announced were also predicated on a rather odd formula that really lent heavily on trade imbalances as opposed to the actual tariffs being levied on US exports. And a minimum tariff level of 10% has been imposed irrespective of the trade balance. The formula was crude, it was unscientific, and didn't take into account services trade, it was simply goods. Market reaction was very swift and all major global indices fell. Subsequently, though, in one of the most dramatic reversals in the admittedly still short time the US president has been in office, the scale of these tariffs was walked back and Trump has announced a 90-day pause on the implementation of the proposed tariffs, reducing all tariff levels to 10%. Now, a large number of counterparties have reportedly approached the US administration wanting to negotiate the tariff level, and President Trump apparently wants to be personally involved in all negotiations, hence the requirement for an extended pause. The exception to that at this point in time is China, and the situation between China and the US has escalated rapidly. As we record this, the US has announced a tariff level of 125% on Chinese imports into the US, because China announced tit-for-tat import tariffs on US goods going into China. All these actions have created historically very meaningful volatility. We have seen breathtaking intraday moves. Now, US companies with a heavy reliance on global trade or that source products from outside of the US are the ones under the most pressure. And I think it's worth noting that the Magnificent Seven, those companies that dominated US and global index performance over 2024, have been affected to a greater degree than the wider market. A Magnificent Seven index is now down 20% from its recent peak in December. The broader S&P 500 index is only down 11%. Now, share markets aren't the only asset class that has reacted to the introduction of tariffs. A metaphorical spanner has been thrown into interest rate markets as well. And interest rate markets are really just now trying to find a consensus around differing potential outcomes. So many questions. Do tariffs dampen down growth? And if so, how does that impact on longer term interest rates? Do growth fears overrun near-term inflation indications? Now, the jury on this is all out until the economic impacts become clearer and the actual enduring tariff levels are set. Financial markets, though, are betting that the lower growth scenario could open the door for more interest rate relief from central bankers. And that's seen money markets pricing a lower Fed funds rate and a lower RBNZ cash rate over the next 12 months than had previously been forecast. And currencies have been all over the show as well. The Kiwi and the Aussie dollar have weakened against the US dollar. At this stage, this seems to be like more of a risk-off, knee-jerk type reaction. We'll have to wait and see where they settle. But look, it's a really tough time for investors, and high levels of uncertainty are kryptonite for financial markets. I want to talk about this. Bear markets and corrections, though, they're part and parcel of being involved in financial markets. There was a major global bank put out a research piece recently identifying significant market drawdowns in the S&P 500 over the last 100 years. Now, in that time, there have been 60 periods that we refer to as corrections. That's times when the market has sold off more than 10%. On 17 of those occasions, the sell-off has continued and developed into what is classed as a bear market, which is more than a 20% decline. In other words, if you average that out, you'd expect a correction every 1 to 2 years, and on average a bear market every 5 to 6 years, which means these market reactions, they're not unusual. They're definitely painful to experience though. So what's the likely impact of tariffs? Well, US growth. In short term, it's likely to be a negative for US growth. It's a significant resetting of global trade policy. It could also add to US inflation in the short term. But I think the most telling impact could be on confidence and business sentiment. That could take a really big hit. We could also see a temporary hiatus in investment as corporate HQs around the world set up their war rooms and they figure out the most appropriate response. And we've seen some manufacturers already slowing production of goods earmarked for the US market. And not only that, we've got to combine this with a potential disruption to US labour markets as a result of tougher immigration policies. What this really means is that risks to growth are lurking around every corner. What does it mean for New Zealand though? Well, the extent of the tariff effects on New Zealand exports to the US is, sort of on a globally relative basis, quite limited. Every year, we export approximately $9 billion worth of goods to the US. So on the worst case scenario, if New Zealand exporters were all the cost of that, it would cost us about $900 million of export receipts. That's unlikely to be the case. But also there is the broader issue of the indirect impact of slowing growth in our major trading partners. Look, there's also the possibility of an influx of goods looking for a market outside of the US, potentially delivering to New Zealand a deflationary influence. In a big picture though, any disruption to global trade is a headwind for New Zealand. And remember, we're highly exposed to the Chinese economy where the trade war is being fought with the most intensity. What does this all mean for investors? Well, investors have given back some of the strong gains delivered by global markets over the past 18 months. So look, it's interesting to note that a diversified portfolio does have some buffers. Interest rate products haven't been affected to the same degree as share market assets. In fact, some interest rate products have gone up in value. There's also the degree of currency hedging in a portfolio. If the New Zealand dollar is weaker and you're unhedged, that's a benefit. What it does do though is it highlights the importance of diversification in an investment portfolio. So what happens next? Well, the situation's very fluid. By the time you're watching this, there could have been further material developments. One of the issues I think is that to some degree, the US government has a credibility issue. The inexplicable calculation of the tariffs makes a rational, considered response from other governments quite difficult. I mean, my view was that tariffs would not be negotiated away, but the extent of the tariffs could be limited and the global trade ecosystem would adapt. Now, this 90-day pause and the dropping of tariffs sort of universally, with the exception of China, would seem to support that view. There is the increased probability of recession in the US. This is important as it will have a dampening effect on company earnings, which have been one of the pillars supporting allocation of capital to US share market. And this is probably the key issue to resolve. A US recession is important. Remember the old saying, when the US sneezes, the world catches a cold. Prior to the tariff announcement, we did lower the exposure to global equities in our model portfolios. We've also tried to bias the portfolio away from large cap US equities. we're also running higher levels of cash in our model portfolios. There's no doubt about it, investment markets are tough, but as I said earlier, market movements such as we're seeing now are part and parcel of the share market environment. Look, we're continually monitoring markets and client portfolios. We're ready to react if we think there's the need to do so, but it's not an easy time to navigate investment markets, which is where we come in. We can help you see through some of these short-term issues. We can make sure that your long-term goals and your objectives are clear, and those investment positioning support those long-term goals. Now you can look us up on jmiwealth.co.nz or on Facebook and LinkedIn. As always, we'd love to hear from you.